Welcome, everyone. Welcome to Correct Capital Wealth Management. Today, I am Colin Day, Joe Anderson, Portfolio Manager, Michael Del Monte, Assistant Portfolio Manager. And today, we're going to talk to you a little bit about the economy. We're going to talk to you a little bit about market performance.
All right.
We've been very popular with our clients, with people that we've been having conversations with in regards to where the market is going, where we've been, and where are the opportunities. So I wanted to have our portfolio managers here today because you guys are the authorities, or at least in my eyes, the authorities on this kind of subject. So, Joe, I'll turn to you first. If we had to think about why we're in the situation that we're in currently, where a lot of doom and gloom, a lot of negativity out there in commentary, how do you think we got here? If you had to give it to the layman.
Awesome. Well, it's a multifaceted question there, Colin.
Sure.
Really you got to start back at what happened after the crash in March of 2020 and the pandemic. And what we saw was a huge amount of stimulus come in, which propped up the economy, probably more than we really needed. So we had a great last couple of years in the stock market. The S&P 500 was up 20% in both of those years, which rarely happens in the history of our country here in the history of the stock market. But we pumped so much money into the system to keep businesses alive during COVID, and then with the stimulus checks to most of the individuals, that people had extra spending money, extra cash, which probably pushed us a little bit too far, too fast in terms of valuations with these companies. And what the real underlying cause is that we're seeing right now is in inflation, which everybody sees. You see it at the gas pump, you see it at the grocery store, you see it at McDonald's, where it's tough to get a meal under $10. So the inflation really started to spook people, and the few ways that you can really combat inflation, are to raise interest rates, slow down the economy, and to stop spending money. Well, we all know that the government's not historically been good at slowing down on their spending. So we're likely, and as we've seen happen, the Federal Reserve is really raising rates, trying to cool off the economy. And that really leads into a big fear where there could possibly be a recession. Generally, when you have really quick interest rates, you have a slowdown of the economy. It's a very delicate balance not to slow it down too much and cause some form of a recession. And that's why we're seeing these markets going haywire. The combination of the worry of a recession with the inflationary issues, and then the fact that it probably ran too far too fast towards the end of last year.
Yeah.
So we're seeing the NASDAQ down 35%, the S&P 500 down close to 25% at the lows, and a lot of negativity. Some of it's justified, some of it's not, just like every other time. But that's really how we got here. And now we just got to figure out how to combat it and where we're going to go next.
Yeah, I found it interesting. I was in a meeting actually with some folks earlier this week, and it's hard to define exactly what the issue is, because what I found was most people want things nice and simple, as we all want things to be nicely packaged and say and point a finger at the one thing that this is what put us into this situation. And it's really just a lot of other things that have affected the market in a way where we can't really point to one thing and say, well, it was the war in Ukraine or it was stimulus. It is really just a combination of just calamitous events that some of us could foresee, others couldn't, and now we're in the situation that we're in right now. So, like Michael, if you had to think about, all right, there's a lot of doom and gloom out there, and that's how financial media works, is that they're not really focusing on the positives. They're mostly focusing on the negative because it keeps you through the commercial breaks, so they can say those ads. When it comes to all the doom and gloom, we've got all this negative press out there. We've got, financial news media just trying to keep you through the commercial breaks to tell you about the next bad thing that's about to happen to us.
I think the worst was when the Arizona green teas went from 99 cents to $1.25.
Oh, that was the worst thing that happened all year, I'm sure.
I'm just saying that.
But where is the positive things? Where are there opportunities when we think about our investors and as we move forward throughout this year, maybe even heading into next year?
Yes, so certainly we've seen a lot of doom and gloom. Markets are down basically across all industries. Energy being the only industry that's up, at one point up 60% year to date, back down to about 25-30%. It's still positive, but we're seeing a lot of turnover in different industries, a lot of people looking for bottoms, a lot of just churn. So a lot of areas that we're looking in go into what we see as the inflationary drivers. This could be metals and mining, this could be oil and gas, just areas that we can see that can benefit from these heightened commodity prices. For example, we're seeing an increase in automobile manufacturing, or to start to an increase in manufacturing. The semiconductor tightness is starting to loosen up a little bit. We're starting to see fabs being initiated across the country. Once Congress can pass that bill to fund these fabs, we're just starting to see a lot of development. We're in the early stages.
Yeah.
It's going to be a long-term 5 to 10 year play, but we're starting to see the early developments. And as those open up, the demand for these base metals like copper and steel, those are going to increase stupendously. Oil and gas for specialty chemicals, for gasoline, for diesel, that's just going to increase. And just to put a metric behind that and why oil is so expensive right now, for 2021, demand for oil was about 97 million barrels a day. Production was at 95 million barrels a day. So we were at a 2 million per day deficit. So if you're wondering why at the pump it's $4 to $5 per gallon, that's the underlying cause. But yeah, those are the two primary areas. We're starting to see consumer staples create a bottom, and that can open up some good opportunity if we do go into a recession or potentially go into one. You know, you still need to buy toothpaste. You still need those hard items.
Right. Your Arizona iced teas.
Your Arizona iced teas.
Some good news out there too is that it seems like inflation may have peaked from some of the numbers that are coming out. That's obviously not written in stone by any means yet, but that would be a great sign to help us into the second half of this year if that continues.
Yeah.
In addition to that, we have an opportunity over the next 8 months here to buy a lot of really good companies at huge discounts, and that's everybody's goal, is to buy a good company at a big discount. And hold it for a long time, ideally.
Yeah.
A lot of folks never thought these companies would go down 50, 60, 70%, but some of them have. And some of us might remember the dot-com bubble. I wasn't practicing back then, but done a lot of research on it. And if you look at the folks who really made a great return over that 20-year span after, it was the guys who got into the Apple, Microsoft, Googles that had collapsed with the rest of tech, but they were still great companies in there. So I think we're going to have a very similar opportunity coming up here in the next 8 months to a year max. So
great.
We're very optimistic long term.
It's like going to Macy's and looking for the deal that's 50% off versus going there and buying it full price or asking for a 3x price.
Yeah.
Right. Personally, I'd rather than 50% off.
Yes, I think we can all agree on that. So if I'll start with Joe first. If there's one thing that you can communicate to investors right now, as we go through this tumultuous time, what's the one thing that you would like to communicate to them so that they either, stay the course or make changes? How do you think you might want to communicate with somebody right now when it comes to their investments?
Well, the most important thing, as you're aware, Colin, is to make sure that you're still working and in touch with your financial advisor. He's guiding you through your process, and he or she is guiding you through your process, and they put you on a track for a reason. There's a reason you're probably not all invested in stocks, and it's for this exact time here, so that you have extra stuff that you can put into the market when the market really falls. The same reason why, if you are all in stocks, you might want to stay in there unless you're too uncomfortable or you're retiring soon. But again, that's something that I'm not going to be able to answer. That's what your advisor's here for. In addition, don't panic. This happens every 4 or 5 years. Usually, you get a good pullback, a good collapse in the market. 3 or 4 years later, historically, you're always pretty much back to where you were. So just be patient and talk to your financial advisor. Would be what I'd say to wait and do.
Awesome, Michael.
Yeah, just stay calm, be patient, let the market do its magic. And, as Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful.
It's a great quote to end on. Thank you, gentlemen. I appreciate your time today.
Thank you.